Hello everyone, this is Dave, aka DREBG. Today is April 6th, 2010. It's 6:30 p.m. Eastern Time, and I am an InformedTrades.com senior member. And I'm pointing that out simply because if you haven't had the opportunity to go over and join as a member or even just check it out, I think you're missing a lot because there's so much free information and good people over there that can help you trade that I think you would really find some benefit if you took some time and headed on over there. So what we're looking at today are a couple of different charts. The first one is the euro-dollar pair, which is over here on the right, and the other is the dollar-franc pair over here on the left. I took some trades on these charts today, and I'll show you why and where we're coming from, but the lesson of the day is supply and demand, and how to identify where those areas are and why they're important. I like to see charts like this that are a low time frame, in this case the 5-minute chart, that are squished together. Kind of gives us some idea of the detail involved and that you miss maybe in some of the larger time frames. But adding something in like pivot points or an indicator here or there, it does give us some level of comfort in confirming where, when we're making our trades. But I'll give you an example. Here's what happens when we add in pivot points. Right now we're just looking at these charts and nothing's really going on. When we add those in, bang, we start to see some framework by which we can formulate our trades. One thing you'll note on the dollar-franc and the euro-dollar pair, obviously, is that they're sister pairs. Dollar-franc and euro-dollar head in opposite directions almost to the pip. So when you can see a setup on one, you can almost always see the equal and opposite setup on the other. Not always, but it's a pretty good bet. So you can see that this framework that we have from pivots, here's these orange lines show the high and low of the previous trading day. Give us an idea of where things are going. When it broke that prior day's level, that may be a good indication of where price action is headed. Likewise, when it broke through yesterday's low, maybe that's a good indication of where price action is headed. We're not really sure, but look what happened here. Today we consolidated right around R4 and retreated. Or likewise, we consolidated right around S4 and retreated back up. The point is, there's definitely something to be said for having a little bit of framework. When I take this back off, one of the things that we're going to talk about is supply and demand, and that's identifying where those areas are. And the setups look like this. They look like kind of the letter M or the letter W. Here's one right here where we went up, price action consolidated, and we came back down to this level here. Here's another one right here. We went up, consolidated, and we came back down to that same level. And then, of course, today, which we'll be talking about in detail, we shot up, consolidated, and came back down. Those same things can be found on the euro-dollar pair in reverse. We went down, consolidated, came up, went down, consolidated, came up, and then today, we went down, consolidated, and came up. So when we look at this in a little more zoomed-in mode, you can see that the candles start to tell a different story where we can kind of get a better idea of where we might want to enter and exit. This pink line, by the way, is the actual price at the time when I took the screenshots, which was somewhere around 1, 2 o'clock this afternoon Eastern Time. And in zooming in some more, this is really where I was trading off of on the 5-minute chart. You can see a few lines on the page, and those lines represent the sell orders that I made here on the dollar-franc with the target below here, and of course the buy orders I made over here on the euro-dollar with the target up here. They're pretty much equal as far as what types of trade and why, and they're just opposite one another. One's a buy and one's sell because they work in opposite directions. So what are we trying to do? We're trying to find those areas where price action is screaming away and then identify where it kind of starts to consolidate and where it might break to come back to that area that it was screaming from. Here's an example. We add in supply and demand levels. Bang. Now we have a different picture. Framework. Again, we identify this area where price action went screaming away upwards. We identify this area where price action went screaming downward on the euro-dollar. Likewise, we then identify the opposite end. In this case, it's where the screaming stopped. It's where it took a break. And that's what we see up here where we've identified this level of supply. Level down here is demand. And of course over here on the euro-dollar pair, here's the supply level and here's the demand level. I should mention briefly how it is we actually draw these levels, and it's really basic. It's a little subjective, but you basically just draw a rectangle or area, a shaded area around the consolidation at the bottom, or at the beginning I should say, of the run-up, and then of course you draw it again on the candle that turns around, and it depends on your time frame. This actually encompasses maybe 2 or 3 or 4 different candles, so maybe one 15-minute time frame would suffice, or 3 or 4 of these candles on the 5-minute time frame. The point is, you want to see where it clearly starts to leave an area. It clearly starts to leave this area. Could you draw it here? Sure you could. Like I said, it's a little subjective, but if you simply take that bottom candle that made the turn, here's the entire candle in euro dollar, this is the turning candle. I just basically encompassed that and drew it all the way across. And you can see that it kept visiting and visiting, and then eventually broke through this trend line here and then continued on. So it's a little subjective, but again, you want to mark off your larger time frame first and then work your way down. So we're looking to find a return to the demand level on the dollar franc, and we're looking to get a return to the supply level on the euro dollar. We start to see something form here is when it starts to consolidate. This up and down action has its own sub-levels of supply and demand. It's respecting this level of supply up here. As you can see, it keeps hitting it and coming back, but it's also respecting some level down here, and that level is good to mark as well. And when we do that, we see these sub-levels form. Here's a sub-level of demand that we're seeing here on the dollar franc, and the sub-level of supply that we're seeing here on the euro dollar. I drew in this line right here just to give us an idea of what might need to break before we get back down to this demand level, or what might need to break here to get back up to this supply level. And when you see price action starting to make its move, you can start to get a better picture of how this actually ends up working. Because what you start to see is that every time it starts to visit this supply level, supply gets less and less and less, and we start to see this retreat eventually all the way down back to the demand level. And likewise over here, we start seeing this demand level get dried up, and eventually the imbalance that's created between supply and demand starts to head back up. I should take a moment to give credit where credit is due. I learned a lot of this from Ruben over at informedtrades.com. He's a member there. And he learned a lot of this from Sam Seiden from fxstreet.com. Excellent stuff. It's really taught me a lot, and I use this. I've been using this a lot lately in identifying where my setups might need to be. Regardless of what strategy you're using, you can always see if you're selling into demand or selling into supply or buying into demand, what have you. And you can need to make sure you recognize that before you pull the trigger. This little green line here is the net short between these two trades. And this line here is the net long between these two trades. So we're looking for about, I think this is about 33 pips net, and this is about the same here. I took my trades, one of them was here, where I thought price action had ceased going up into supply, so I placed my trade here. It didn't. It came back, tested demand again, and went back up, and almost went through the supply level. It seemed like a good place to go short again, because I felt strongly that it had the ability to get back down to demand. And indeed, when you see the next chart, you'll see price action right here on the dollar franc and right here on the euro dollar shoot right up into those levels. We see that there and that here, right up into the point where it's almost triggering my target on the euro and not quite down on the franc. Let me go back. You'll see these candles again. Boom, boom. I actually ended up getting out of these trades. I didn't want to be greedy. I felt good about it. I just wanted to take my profit off the table, which was rock solid. And the net of the trade looked like this. Short the first time, and where I got out, where I entered short the second time and got out. And likewise where I entered long the first time and got out, and long the second time and got out. If you remember, I'll go back one, you'll see where the trades were on the chart again down here, 106.82-ish. And here was 133.98-ish, and then going back here, 106.81-ish. It's since reached the targets. I just didn't carry the trade as long as my targets were anticipated. Lastly, here's a 15-minute chart showing clearly this run-up, consolidation, and run-down, consolidation, and run-up. And that's it. All we're really trying to do is identify these areas and play price action off of those areas. It's one of those things that you get better as you do it more often, and hopefully you got something out of this. Thanks again, guys, and catch you on the next one.